Welcome back to the RTP revision video. Yeah. So today we'll first start with in the S20, which is respect to the government grants. Okay. So let's begin. No further delay. Yeah. We've almost started, right? To encourage the entities to expand their operation in a specified development zone, the government provides interest-free loans to fund the purchase of manufacturing equipment. In accordance with the development scheme, the entity receives an interest-free loan of 5 lakh from the government for a period of 3 years. The market rate of interest for similar loans for 3 years is 5 per year. 5% per year, and no other performance conditions. Discuss how I have to treat this. Okay. The entity measures the loan on initial recognition. I have to do the discounting, right? I have to do with the discounting at 1.05. 1.05 to the power 3 raised to the power 3, right? 5 lakh divided by 1.05 raised to the power 3. So that would result at 4 lakh 32,000. The difference 68,000 would be treated as government grant. The difference 68,000 would be treated as government grant. Okay, because there is and is recognized immediately as there is no further questions. Okay, so here what will be there? Bank account debit 5 lakhs to loan 4 lakh 32,000 to income 68,000. To income 68,000, I'm recognizing directly at profit and loss account because there is no performance condition attached there. But okay, so then at the end of year 1, finance cost account 21,600. 21,600. How does this come? 32,000 into 5%, 4 lakh 32,000 into 5%. Okay, that will be treated as finance cost to loan liable. Loan. I'm not, this is interest free loan. There is no interest which is actually charged. Okay, but I'm going to treat it as interest and I'm going to credit the loan account. Similarly, year 2 for the raised amount, so 4 lakh 32,000 plus 21,600 into 5%, which results in 22,680, which results in 22,680. Clear? This amount is also clear. Then the third one will be the balancing figure. Okay, generally balancing figure, and you are going to pay out. So loan account debit 5 lakh to bank account 5 lakh being loan repaid to the government. So with this, government grant question is also completed. In this 1 or 2 share based payment. Okay, so here let me take it. We will read only this table. Okay, so grant date here is 30th June 20x1. Okay, measurement date is also 30th June 20x1. Base for grant date, the date on which the scheme was approved by the employees. The date on which the scheme was approved by the employees, that will be the base for the grant date. While for the measurement date for employees, the grant date is the measurement date. The measurement date is the grant date. Measurement date is the grant date. Okay, then for the next one, what is the second requirement here? First was employee. Second was purchase an IT equipment. Purchase of IT equipment. Just give me a minute. It is moving too fast. Yeah. First April 20x1. That is the grant date. Measurement date is 30th July 20x1. What's the basis for grant date? The date when the entity and the counterparty entered into a contract. Contract date would be the grant date, while the goods obtained, okay, that date would be known as measurement date. Then the date for approval of shareholders was obtained. That will be the grant date. For employees, measurement date is the grant date. That's 30th September 20x1. So let's move on to the next question. It's quite a big question. The following I don't know why it's not moving. Just give me a minute. The following particulars in respect of stock options granted by a company are available. Number of employees covered 400, nominal value per share 100, number of options per employee 60, and exercise price per share 125. Okay. Now, shares were offered, were put in 3 groups. Group 1, 20% of shares were offered with vesting period of 1 year. Group 2, 40% of shares were offered with a vesting period of 2 years. Group 3 was 40% of shares offered with 3 years. Fair value of the option per share on the grant date was 10 rupees. Group 1, 12.5, Group 2, 12.5, and 14 for Group 3. Okay, position on first year. Number of employees left 40. Okay, estimate 36, 34. Excising the option in group 1 would be 350. Group 2, okay, 35, 30, and 319. 28 and 295. Options are not excised immediately on vesting. Options which are not excised immediately on vesting are forfeited. Compute the expenses to be recognized in year and show important accounts in the books of the company. So we'll do only the calculation. Accounts, you are very much mastery in it, right? You are a master in it. So first, total number of options per employee, it is 60. It is 60, number of options per employee is 60. So group 1 is 12. See, what I'm telling is, out of 60 options, I'm going 20% is given for group 1, 40% is given for group 2, and 40% is given for group 3, which means out of 60 options, 20% is nothing but 12. 12 options is for group 1, this is nothing but vesting period of 1 year. Group 2, it is 2 years. This is quite tricky, right? You will think, why this one? Yeah, okay, understood. Now you understood, right? Yeah. Group 3 is period of 3 years, 24 options. Now, computation of expense. Group 1, Group 2, Group 3. For first one, we'll complete Group 1. It's very simple, right? So, number of options. Employees at the end of year end. So, who are there for first year? Because Group 1 is vesting period is only 1 year. So, how many employees left? 40 employees left. So remaining employees will be 360. Remaining employees will be 360. Expected to leave, I'm not going to consider it because it is already vested. Okay, number of eligible employees is 360. 360 into number of share options is 12 and value of per option is 10. So 360 into 12 into 10 is nothing but 43,200. 43,200. 43,200. Okay, expense to be recognized as 43,200. Expense to be recognized as 43,200. Clear? Now, let's move on to group number 2. It is also quite easy. Okay. Now, group number 2. It is vesting in second year. Vesting in second year. So, employees at the year end is 400 minus 40, which is nothing but 360. Who is expected to leave in second year? Who is expected to leave in second year? 36. Expected to leave in year 2 is 36, right? 360 minus 36 is 324. 324. What is number of shares I'm going to give? 24 shares I'm going to give. The value is 12.5. That's why the value of total options is 97,200. So, it is vesting over 2 years period. So, 1 by 2. 1 by 2. So, 48,600 will be the current year expense. 48,600 will be the year expense. So, for the next year, what happens? Number of employees at the year end is nothing but I have told actual employees who are there was 360. Who have left the current year 35. 360 minus 35 was 325. Okay, 24 shares per employee and then 12.5 same 97,500. 97,500. So what I'm already recognized is 48,600. So balance will be recognized as expense for the current period 48,900. This is with respect to group 2. So this 2 will total up to 97,500. Now moving on to third one. This is quite interesting, right? 3. Okay, year 1. In year 1, there are 400 employees. 40 have actually left. Okay, and 36 are planning to leave in year 2 and 34 are planning to leave in year 3. Okay, so you have only 290 employees. 290 employees. 290 into 24 into 14. That is value of the option. 97,440. 97,440. Over 3 year vesting period. So 1 by 3. 32,480 will be the expense for the current period. Expense for the current period. That is year 1. For year 2, 360 actual employees which are there in the year 1 end, right? And 35 have left during the current year. So 325 will be there. Planning to leave. 30 are planning to leave in the next year. So 295 is the expected employees who is eligible. Okay, so 295 into 24 into 14 is 99,120 divided by into now how many years have completed? 2 by 3. 2 years have completed. So 2 by 3 have completed. I should have recognized the expense to the extent of 60,080, but I've already recognized 32,480. Balance I'm going to recognize now 33,600. 33,600. Clear? Now then here in the third year, actual employees were there at the beginning of third year was 325. When 28 have left during the year, okay, and then there's no expected future leave, like because it is vesting during the current year. So 297 employees are eligible now, okay. 297 into 24 into 14, that is a fair value. I'm going to get 99,792. This is the last year, right? So I have to recognize entire thing by now, right? So 99,792. I have already recognized the extent of 6,080. Balance at 3,712 will be recognized in the third year. Will be recognized in the third year. Okay, clear. Now, employee is not exercising the option. Employee is not exercising the option. Okay, here I am thinking that employees will be exercising the option. 350 employees will be exercising the option. But okay, just give me. Sorry. Just give me a minute. This is the expense. How many have exercised it? out of 360 employees eligible, only 350 have actually exercised, right? That is 10 employees have not recognized. 325 minus 3, and similarly for 6 employees has not recognized the group 2, and 2 employees have not recognized the group 3. Okay. Okay. This amount will be transferred to the retained earnings. This amount will be transferred to the retained earnings. This amount, okay? The amount, this is the important point here. The amount of those whom have not exercised the option, that amount will be transferred to the retained earnings. That amount will be transferred to the retained earnings. That is the important point of the journal entry. Nothing else is important, okay? So let's move on. That is first time adoption of Indias. It's quite important standard because it's highly important, because only one thing is there, because if you are not doing it properly for the first time, then everything else will be wrong. Okay, that's how it is important practically. Okay, academically still important, but many students tend to leave this chapter. At least, and I request you at least to do the book back questions and then illustrations. Just go over it at least once, the past MTP, RTP questions. Okay. While preparing the opening balance sheet on the date of transition, an entity is required to recognize all assets and liability whose recognition is required by Ind AS, reclassify the items that is recognized in accordance with previous cap as one of the asset liability, but a different type of asset and liability in accordance with Ind AS, apply Ind AS in measuring all recognized assets and liabilities. Give examples for each of the above 4 categories. Okay. See, this is quite an important theory question. Okay. This covers the purpose of the entire standard. I mean, the scope of the entire standard. So, I personally request, at least uh, after watching this video, or get past this video now, right now, and please read this answer. Please read this answer. Make some keywords. Note the keywords and please revise it before going to the exam. Even though the same exact question is not asked, if one not one related question is asked, you could code this one and this will fetch you marks. This will fetch you marks. The one thing which made me to score 81, I usually say, right, that was because I have not left any chapter in FR. Okay, you would ask me why you have left not. Yeah, I could have compromised, but I'm not compromised anything in FR. Okay, because this is the paper. Okay, it's going to design the entire 7 papers your slide, because the minute you have some demotivation from this paper, every other paper will be impacting. So please be very careful. Okay. Yeah. Let's continue. The examples of items that the entity may recognize, de-recognize, remeasure, reclassify on the date of transition are as under. Recognize all the liabilities whose recognition is required by Indias. Like, for example, customer-related intangibles. If an entity elect to restate the business combination, style-based payment for non-employees, and recognition on deferred tax on land. Okay, these are the items which are recognized to be recognized as per the Indias. Reclassify the items. What are the things to be reclassified? Redeemable preferences we have been classifying as equity there. Now it has to be classified as liability. That has been classified as liability. We will say, as a kids, we would say the preference share capital is forming part of equity. Forming part of equity. Now it is not. It is forming part of liability if it is redeemable. Non-controlling interest, which have been earlier classified outside equity, now I am to forming part of thing. Okay, I have to show it as non-controlling interest, a separate line item. Now, apply in this in measuring all recognized assets and liabilities, discounting of long-term provision. We are not discounting earlier, right? Even if it is payable after 10 years, I'm going to do the same amount now. Okay, that's discounted, right? That is via in the yes. Measurement of deferred income taxes over all temporary differences instead of timing differences. Money for timing difference we are doing it, but for all temporary differences we have to do it now. Okay, and then let's move on. Now, the third question. On 1st April 20X1, Neogen has granted 1,20,000 share option to its employees with vesting condition being a service condition as follows. Vesting date 31st March 20X2, 80,000 share options. Vesting date, just give me a minute. Okay. Vesting date 31 March 20X5, 40% share options. Each option can be is 1 year and 4 year vesting period. Each option can be converted to one equity share of Neogen Limited. The fair value of the option is 20. Neogen Limited is required to prepare India's financial statement for the year ended 31st March 20X4. Disclose publicly the fair value of both the equity instruments, estimate the measurement date as defined in India's 102. The previous applicable gap, their entity had not adopted the intrinsic method of valuation. Share options have not been exercised by the employees. How the share-based payment should be reflected on 31st March 20x4, assuming that entity has erred by not passing any entry. There's no entry which has been passed earlier. Okay. As on the grant date. Okay. For 80,000 share-based option vested before the transition date. See, this has already been vested. Okay, this has already been vested. This is going to vest in next 1 year. Okay, Index 101 provides that first-time adopters encouraged but not required to apply Index 101 that vested before the date of transition. I'm encouraging you to do so, but I'm not forcing you to mandatory do it. Okay, that you could do apply Index for the grants which have been vested before the transition. Hence, Neogen may opt for the exemption given in India's 101 for 80,000 share options vested before the transition date. However, since no earlier accounting was done for these share-based payment under previous cap, there is this lead to error on the transition date as directed on the reporting date. Hence, being an error, no exemption can be availed. See, it has done an error by not putting any entry. So that I am to rectify this error while preparing the financial statement. Error has been discovered, which is a prior period item. The error should be corrected by restating the opening balances of relevant assets or liabilities and relevant component of equity. This will result in consequent restatement of balances of as at 1st April 20x2. Accordingly, a retrospective calculation of star-based payment with respect to 80,000 share options will be creating a share-based payment reserve equity 16 lakhs and correspondingly adjust the same to the retained earnings. Adjust the same to the retained earnings. 80,000 into 20. Okay. 80,000 into 20. That would be 16 lakhs. That's the amount to be taken to share-based payment reserve. Okay. Let's move on. For 40,000 share-based payments, going to vest. Now I am the transition date of 31st March 20x4. And now the next one is 20x5. Since the share-based payment have not vested before the transition date, no option as per in this one is available to Neogen Limited. It will apply in this one or two retrospectively. Did not account for the same at the grant date. This will result in consequential restatement of balances. Adjustment is to be made by recognizing and adjusting the retained earnings by 2 lakhs. Why it is 2 lakhs? Let's see it. Okay, 40,000 into 20. It is 8 lakhs, right? Okay, let's see it. Okay, and this has 4-year vesting period. 8 lakhs is 4-year vesting period. For each period, it will be 2 lakh, 2 lakh, 2 lakh, 2 lakh, right? So, for the first one, it is 2 lakh. And then again, 31st March 20x3, share based payment reserve asset would be understated. So, that's why I have to correct it by 2 lakh and again 2 lakh. So, at end of 31st March 20x1, share based payment and employee expense will be debited by 2 lakh. Now, the share-based payment reserve will show an amount of 6 lakhs. Cumulative expenses will be 6 lakhs. Okay. Every year I will debit and credit. Okay. Clear? So, let's move on with the one last question before we wind up. Cost of completion of work in progress. Okay. Are incurred since the nature of completion cost will be included. Right. And then the same should be deducted from the estimated selling price to arrive at the NRV. See, this is while determining the NRV. Then trade discounts then allowed either expressly through an agreement or through prevalent commercial practices. Trade discounts are expected to be allowed and should be from the estimated selling price. Cash discount is only for the payment condition, so it will not be allowed while calculating the NRV. So next question. Retailer company imported a cost of 1,30,000 including 20,000 non-refundable import duties and 10,000 per refundable purchase taxes. The risk and rewards of ownership of the imported goods were transferred to the retailer company upon collection of the goods from the arbor warehouse. The retailer company was required to pay for the goods upon collection. The retailer company incurred 5,000 transport to the goods to the retail outlet and further 22,000 in delivering the goods to the customer. For selling cost of 3,000 were incurred in selling the goods. Say to the delivery charges and selling expenses will also form part of the inventory. If not, why? Also calculate the cost of inventory. What is the purchase price? Purchase price is nothing but 1,30,000. Okay, 1,30,000 minus 1 is 10,000 minus 1 is 10,000. Okay, that is non-refundable. Refundable. So 1,20,000 will be forming part of purchase cost, and then transport cost till only till the first. I'm going to store somewhere like till that only the transport cost will be allowed, right? Beyond delivery cost, that will not be added to the cost of inventory because that will be charged to profit and loss account. So 5,000 will be added to the cost of inventory. So 1,25,000 is the inventory cost. Then In this, to specifically exclude selling cost from forming part of inventory. However, selling costs are generally used as single term because they relate to selling cost, and sale and distribution are selected. Okay, then. Since these costs are not related to bringing the goods to present location and the condition, the same are not included in the cost of inventory. Although, according to the word, though the word is not specifically mentioned, these costs continue to be excluded. Therefore, it excludes selling expenses incurred 2,000 delivery and 3,000 selling cost. Paragraph 16 of India's 16. Okay. Cost of an item of PPE comprise initial estimate of cost of dismantling and removing. I guess there's something wrong which has been included here. No, wait. Yeah. There is something wrong, so you can ignore it. Okay. Like it's an error. Just fine. Okay, so next video will discuss the remaining parts. Thank you so much.